Hello everyone, my name is Reese, and in this video I will be kicking off a mini series that I'm calling In a Nutshell. And if you go on my channel, you will probably see that most of my videos are a little bit more in-depth technical review videos where I'm getting into a little bit more longer in-depth videos, such as my dividend growth versus high yield video, which was about 25 minutes long. Most of my videos are over 10 minutes long on average. Some of them are even 40 minutes for my 401k video that I did recently. So the purpose of this series is to take away all of those key pieces of information, putting it in a nutshell, talking about everything that I found in those longer videos, condensing it to a more playable video for viewers who might have a shorter attention span, or they just want to get to the details without going through all the nitty gritty to get through straight to the key takeaways. So to start off this first video, I will be doing a in a nutshell version of the high dividend versus high growth dividend investment video, where it was dedicated to comparing the pros and cons between going after ETFs or dividends with high dividends versus growing dividends. And this is going to get straight to the key takeaways. I'll put a link down below for those who want to watch the original video if they really want to understand. But the key takeaways was I compared the two most popular dividend funds, which I used ETF.com, went to the dividend investing ETF channel, and right now the top three by assets under management are VIG, VYM, and SCHD. And so in the video, I compared VIG, which is the Vanguard Dividend Appreciation ETF, which focuses on dividend paying funds or dividend paying companies with a history of growing dividends. And then VYM is the Vanguard High Dividend Yield ETF, which focuses on companies with above average dividend yields. As of right now, VYM is paying a dividend yield. I believe it's right around 3.4%. Let me see. I'm not, so 3% right now based off current market conditions, which is, right around double what the overall market is. And then VIG, both of these have very low expense ratios of 0.06, and they have quite a bit of volume, so they're easy to get in and out. 1.92%. So high dividend growth companies are usually going to have lower dividend payouts overall, whereas high dividend yield are going to have high above average market dividend payments. So the key takeaways when talking about these funds is what we found was that, so in blue is VYM, high dividend yield, and VIG is shown in orange, high dividend growth. And so what we found is what you're paying for companies that have above average dividend yields is that you are typically going to get lower capital appreciation. So companies with less dividends, usually if it's a good fund and the companies are doing well, rather than paying out those dividends or those profits to dividends to investors, the companies are reinvesting those dividends, helping them grow their company. And so companies with growing dividends are usually growing companies, and you are getting rewarded with growing share prices. On the other hand, companies with above average dividend payments they might not be growing as much through the share price. And so, for example, if we invested at the bottom of the 2008 financial crisis, that does kind of change the picture. But from for the most part, depending on any point of time, VYM has underperformed VIG when it comes to share price appreciation. So those higher dividend payments you're getting those higher dividend payouts in exchange for lower capital appreciation. And we also found, though, is that when you reinvest those dividends, that gap kind of closes together for the most part. And you'll see that regardless of when we scroll it, there's periods where VYM will still trail overall. A lot of throughout the life of the fund, suddenly it becomes much more closely matched, including even if we pull out the S&P 500, VIG, shown in orange, is done very well with tracking SPY. Now, granted, this does vary depending on any point in time, especially year to date. This is where dividend companies can really shine. VYM is actually up 0.18% so far. VIG is down about 9%, and the overall market is down 16% when reinvesting dividends. Take away the reinvestment, and still VYM is doing pretty well. So, in a nutshell, everything that we found, high dividend yields are a little less volatile than the overall market. Their dividend companies in general might be a little less volatile compared to growth companies. In exchange for these higher dividend yield payments, you are getting less capital appreciation. So the in a nutshell version is that dividend growth might be better for those who have a longer time horizon where they want their assets to compound and grow over time, especially in like a retirement account. If you're in your 20s, you don't want to put all your money into high yielding assets that might not offer you good growth. On the other hand, if you are someone who's seeking income now, some sort of dividend payments or something, some sort of supplemental income, higher dividend yielding is a great way to kind of help supplement that, as long as the fund is actually giving you quality dividends that are not. That's why I'm using VYM as for example, is because I think VYM does a pretty good job of what it's seeking to do. So if you're someone who's willing to reinvest those dividends and you have a long-term time horizon, I think dividend growth is going to help suit your needs a little bit better. And if you're someone who's trying to get those, passive income, higher yield is going to be a little bit better option in exchange for lower capital appreciation. Because if you're getting high yields without selling your shares, that is a great position to be in, because you can be in a downturn and still getting your dividends without worrying about selling your shares. And then another thing to keep in mind is that both of these funds count as qualified dividends. So you are not actually paying dividend or income tax on these dividends. You are paying capital gains. And so capital gains are usually more favorable tax brackets. For example, as of right now, I believe it's like up to $40,000 or up to $44,000 in capital gains is tax-free, minus, Social Security or Medicare. And so you're getting a pretty good tax break when you're investing in qualified dividend paying funds. So both of these are qualified dividends as long as you hold the security for at least 30 days before the dividend payment. That can be great if you're holding these in a taxable account, such as a personal brokerage account. Whereas if you have a Roth IRA, for example, it really doesn't matter as much. So if you have a long-term time horizon, when I'm saying long-term, I'm saying 10 years or more, I think dividend growth is going to be a better position for you, but it can be nice to start adding to that position with some sort of high yield, such as VYM, where you can let those shares compound over time and purchase more shares of itself. So that concludes what I think are the key takeaways of what I was trying to get at in the longer video. I hope to do more videos like this where I will do the in a nutshell version and link to the original video where it's a little more in depth, more technical for those who actually want to be walked through the actual steps and analysis that I performed to really understand where these results are coming from. So I'll leave a link down below for that video. So thanks for watching, guys. I hope that all made sense. This is the first in a nutshell I've done, so it might be a little bumpy to start off, but hopefully we get it dialed in as time goes on. Thanks for watching, guys. If you want to support this channel, feel free to leave a like, comment, subscribe. Feedback is greatly appreciated so that I can look into it to help make future videos better. Thanks for watching. Peace out.